Good morning, everybody. Welcome to the Flow Show. Busy day already. Morning, Kay. Morning, Stel.
Good morning, everybody.
How are we all doing?
Very good. It's a new month. Let's make it a good one.
Pinch punch, first of the month, no returns. I'll get in before you do. Right, lots to get through to today, so let's crack straight into it. Big day today already, PMI day, lots of stuff going on, big numbers from around the world. Let's start, let's just go through the data, sod it. So CPI, surprise to the downside in Australia. This reverses a lot the prior month, which saw a surprise jump in inflation. It's caught a few on the hop. So inflation down or now growing at 7.4%, much lower than the 8.1 expected, and a whole 100 pips below the 8.4% prior. GDP in Australia positive, but not as much as expected on the quarter. Year on year coming in as expected. In Japan, manufacturing PMI touch better, but still very much in contraction. Again, we keep speaking about this divergence between manufacturing and services, which is looking a bit better. Then we drop into China, and every PMI that they want to have a go at is coming up roses. Manufacturing 52.6 versus 50.5 expected. Non-manufacturing services, that's 56.3 versus 55 expected. And the Caixin manufacturing is 51.6 versus 50.2 expected. So all the negativity around the virus wave seems to be in the rearview mirror already, if the data is to be believed. And,
virus? What virus?
Yeah, exactly. Must have been good for the economy, the old virus. Anyway, that's what's good for China is often seen as being good for the global economy. So, that's going to be translating into risk, as we are seeing in part today. Coming through the rest of the data, regional German CPIs coming out, mostly rising. North Rhine coming in 8.5% versus 8.3 prior. Let's see if it's got the other numbers on there. Sometimes it doesn't. Yes, it does. So see some of the others there, 8.7, up 2 pips, unchanged in Bavaria, unchanged in Brandenburg, a little dip in Hesse, and Saxony was out as well. There we go, unchanged there. On the whole, inflation isn't coming down, and it's coming down in part, but not wholesale, and in some cases going up, just like we saw from France and Germany yesterday. So still sticky numbers coming from there. Just scrolling up to go through the PMIs that we got from some of the countries in Europe. Spain, manufacturing moving into expansion. Italy moving further into expansion. France letting the side down, going further into contraction. Germany moving up, getting worse in contraction there. So not a level playing field in the manufacturing sectors in the Eurozone. Coming down, let's have a look at Greece. Oh, look, go Greece, 51.7.
That's
what are you doing, Stel?
That's my wife.
Is that your surfboard production kicking in?
Hey, we've been through so much crap that at some point you have to recover, right?
Yeah, they say even a blind squirrel finds a nut now and again.
Now, in all fairness, and I don't want to be biased, although one of my very, very close friends is a minister in the current government. This current government has done a lot. And I mean, I do mean that. And I'm usually very cynical, and they've done really well. They're trying to do a good job. So, I'm happy about that. But anyway, go Greece.
Yeah, that job they've done was just squeezing more shekels out of the Eurozone. But yeah, it's quite surprising because over the GFC and the banking crisis and all that sort of stuff, there was a little bit of a revolving door on Greek politics, wasn't there? It seemed like every other week there was a general election and another 200 parties.
Greek politics has been dominated by two families over the past 30 years, and it's still the current prime minister is the son of a former prime minister, etc., etc. But at least he's educated at Harvard, and he's put together a very, very good team. So anyway, let's
Long
not
may
dwell
it
on
last.
Greece too long. But yeah, I'm happy about it.
Yeah, long may it last, mate.
Yes.
Right, so just looking quickly at the UK data as well. The PMI, a slight improvement there as well, 49.3 versus 49.2 expected in the prior flash number. Still in contraction though, but it's the first rise in some 8 months, so looking okay there. The consumer credit numbers were a bit worrying. Mortgage approvals coming in a bit higher than expected, but still running at quite low levels. Mortgage lending a bit softer. The BOE consumer credit came in at 1.597 billion. Now, the issue we have here is that some 1.1 billion of that was credit card lending, i.e. people using the plastic. This has been running pretty low recently, no red flags from this at all. So that jumped to 1.1 billion in credit card spending we need to keep an eye on, because if it continues, it could be signaling that finances are tight amongst UK consumers, and thus they're having to put more on the plastic, the short-term credit. That can impact spending, activity, debt, that sort of thing further down the line. Could be a crimp on economic activity if that continues. We know that January was a big retail month, as we've seen around the globe. Could be a signal here that it was all put on short-term credit. So we just need to keep an eye on that. If we get a couple more readings, plus numbers there, that may start signaling some problems for the UK economy to come. That's it from the data up to that point. So let's go through some of the headlines. The SCMP had a piece out yesterday saying that Beijing's reunification plan for Taiwan is on a fast development track. Now, there's those who may recall, a lot of people are thinking that perhaps nothing will happen until maybe sort of 2027, something like that, in terms of when China will be ready to make a move towards Taiwan. This type of headline will get people thinking that may come quicker than that. It's all playing into the geopolitical tensions going on between Russia, US, China, Ukraine, Taiwan. It's all bubbling away still. So that headline, not good for that situation. Over to the Bank of Japan, and Nakagawa said it is important to keep supporting the economy with easy policy for the time being. The recent rise in inflation has been driven by a spike in prices for a handful of goods, which will likely clearly slow their pace of increase. So again, following the party line for now, that easing is good and that inflation is temporary. We shall see. BOE, Elizabeth Mann said lower energy prices might push up consumer spending. Well, not if everyone's spending it on the plastic, it won't, as we've just seen, potentially. Bailey was just out, and he's getting some splinters from sitting on that fence about rate hikes. He said, I would caution against suggesting either that we are done with increasing the bank rate or that we will inevitably need to do more. So we could hike or we might not hike more. And then he said, if we do too little now, we risk doing too much. If we risk doing too little now, we may need to do more later. So he's thrown out some dovish comments and some hawkish comments, just making things, as usual, a big old mess as to try and understand what the hell they want to do. But as Kay will no doubt point out, Bailey's spoken, the pound has dropped, regular as clockwork. The UK Treasury is looking at a potential U-turn on the cut to energy subsidies. This is the support the UK government is giving firms and consumers to do with energy price rises. That was set to end in April. Now they're looking at maybe continuing that for a bit longer. ECB's Wojcik said inflation is looking quite persistent. Companies are changing prices more frequently. ECB's Muller says expectations of rapid ECB rate cuts is wishful thinking. Germany's ECB's Nagel said further significant rate hikes beyond March may be needed. Rate cut talk is a non-starter until sufficient evidence of underlying inflation drop towards targets. She favours a steeper reduction of the APP portfolio from July. On the ECB, Goldies expect the ECB now to hike 50 BPs in May versus their prior estimate of 25 basis points. They also raised their ECB peak rate to 3.75 in June versus 3.5 previously. So everyone getting more hawkish over there. Canada data from yesterday as well. Let's go back. GDP a little disappointing. There we go. GDP a little disappointing from Canada. Quite a sizable miss on the quarter. Came in flat. It was expected to rise 0.6%. The annualized number as well coming in flat, and that was expected to rise between 1.5 and 1.6% prior. So a bit of a soggy end to the year for Canada. Some house price data from the US came out. The monthly numbers all pretty soft, coming in negatives yet again. The yearly counts for the S&P 20 City came in at 4.65 versus 6.76 prior. The national house price index was 5.76 versus 7.62 prior. The FHFA house price is 6.6 versus 8.2 prior. Those are the year-on-year numbers, so indicating a slowdown in price rises coming into the US housing market, no doubt as rate hikes are biting. US consumer confidence was out yesterday and bucked the trend, really. We've been seeing some positive data out the US, fueling those rate expectations and hawkishness from the Fed, and yet it dropped to 102.9. Much worse than the expected 108.5 and down on the 106 prior. Those all-important inflation expectations, one-year CPI expectations came at 6.3 versus 6.8 prior, although that was revised down to 6.7. So consumers also feeling that inflation may be coming lower, although still running at a higher rate. So that took a bit of a steam, let the tires down on the hawkish expectations for the Fed on those numbers there. Hasn't stopped some banks thinking that the Fed might get to 6%. Bank of America research said they might have to raise rates that high to combat everything that's going on. Target, a big retailer in the US, has apparently announced plans to open 20 new stores and invest 4 to 5 billion this year. A big headline, that one, considering they're in the retail sector, and that they're going to be increasing stores by significantly and putting a lot of money in. Firms can tend to dry up on the capex spending if they feel the economy isn't going to perform, but a bit of positivity seen by Target for those plans there. And US Secretary of State Blinken said we will not hesitate to target Chinese companies and individuals who violate our sanctions on Russia. So further warning there about China potentially meddling in the Ukraine situation by providing arms or getting further into bed with Russia. That situation not going away. There you go. 15 minutes, all those headlines. Right, you two, anything you want to pick out the bones of that lot?
Well, you covered it as always. All I want to say is that yesterday's numbers are definitely a step back for the Fed, or if I put it another way, an extra excuse for them to be less hawkish. Consumer confidence is a number that we know they pay extra attention to, and that was a big drop. And the Richmond manufacturing numbers were really not good either. We have non-manufacturing ISM this week. Is it today? No, it's not today, is it? Oh,
Yeah, I
ISM
think
manufacturing
today,
today,
yeah.
non-manufacturing tomorrow, or something like that. These are going to be very important. But we've said it before. The U.S. economy is doing okay still, but the main part where it's doing okay is employment. And there's all sorts of caveats and details that you need to dig into that. And there are many factors that show that the quality of employment is dropping. But in any case, the U.S. economy is still not doing bad, but we are seeing signs of the tightening slowly taking effect. And you can bet the Fed knows that. So, I think every opportunity they get, they're going to use to kind of calm markets down. They don't want to have a market crash. Definitely, we've come down, 20% from the highs in the S&P. So, for them, an orderly move lower is desired. And if numbers continue to show mixed signals, they're going to adjust accordingly. And so, I just wanted to point out that yesterday's numbers are not to be, frowned upon. They're not to be saying, yeah, no, don't worry about those. I think they're important. And this week's numbers are important as well, because they're very, these ISM numbers are leading indicators. They can move markets. But, apart from that, I think you covered pretty much everything.
Just do you think it's perhaps a little bit of a reality check that not to get too far out your pram on hawkish expectations?
Yeah, and also look at real rates, right? If you look at core PCE, we are basically at going to positive real. Are we already at positive or almost at positive? So that's what the Fed wants, and the Fed want to keep real positive rates until inflation comes down. And as long as the path is lower, I think they're going to just keep doing 25, 25, 25. I think they're probably going to do a little bit more than the market expects and stay there for a little bit longer. But, I really don't see any reason why they're going to start doing 50s unless we see CPI, starting to go up in a big way. So yes, a little bit of a reality check, something for both sides over the past few weeks in terms of data. And, we keep going.
Yeah, no, exactly. And one of our guys in our chat room this morning asked why is the dollar soft even though US rates are holding up? And the simple answer for that is we've obviously got some risk on with the stuff that's happened in China, the positive data in China. But even so, the rest of the data in Europe, those PMIs improving, inflation in Germany staying up, inflation yesterday in France and Germany going back up. We're playing in Europe the same game now, the higher for longer game that we've been playing in the US for the last couple of weeks. This is a bit of catch up on the European side. We've had a bit of repricing of the US, yields going higher, Fed expectations going higher. Now we're getting the same in Europe and the UK. It's their turn to do the same thing. So all yields are holding up. But we've moved already significantly on the dollar. Now we're having a little bit of a move on the rest. And obviously, if euro's being bought, if sterling's being bought, that's going to affect the dollar half of the trade, because that side's already been done. So that's why there's a bit of disparity with the dollar. It doesn't mean the dollar's dead and buried. It just means this is now Europe's turn and UK's turn to play a bit of catch up in that higher for longer trade. Kay, what did you make of that data from China? Surprisingly strong, really.
Again, we have to. Okay, let's take it for face value. They are strong, and that is one of the reasons as well that euro is stronger, because the market perception has been and is that Europe is perhaps a bit less anti-China than what may happen in the US. And as a result, we are seeing the euro actually benefiting from better data in China as well. But that, I think, is just some form or only a small part of what's going on. We've seen the market being very surprised by it, because dollar China was what, 695 going to bed, and we wake up at 690, and now we're below 690. So it really comes as a bit of a surprise. Remember also that, let me just recheck, those are January data, right? No, February. Okay, that they must have been coming out of their COVID situation much faster than people expect. Now, yeah, they are a bit surprising. And as I said, yeah, that also plays a part in the euro. Together with the yields, and I'll show it a little bit later, European yields are really pushing towards decent levels here, and a break in lowering bonds, higher in German yields, because these are the main benchmark, could put even more upside pressure on the euro. And then as already said, we have to take it in. We have to take everything in combination, right? We've said yesterday that or in the chat rooms that those numbers in the US were not really nice, but we were in full end of month swing, and despite those numbers being weaker, the dollar got bought towards the end. The 4 p.m. fixing, the end of the day, people seemingly needed dollars. So and we are seeing a bit of counter effect of that as well this morning. So there's a lot going on, despite U.S. yields not moving, and that in the rest of the stuff. So yeah, I think that explains where we are now. So back on those data, yeah, I think it's a tad surprising. It should be positive for stuff like commodities, perhaps a bit of oil, even though that is not responding at all. Yeah, it's let's say it's like one number, but it's taken the market on the wrong foot, right? And so now we need to correct again. I also think this afternoon, after those yesterday's US data, this afternoon the ISM and the S&P manufacturing PMI will be quite important. We know that manufacturing is lagging a little bit on services, but if we get a negative print, this market is fast enough to punish the dollar again, and I don't think it will refrain from punishing the dollar, because it loves to do that. So yeah, I'd be a bit cautious on those numbers this afternoon if they confirm a lower print. If they in turn confirm a higher print, then so that it's going to be a binary event for me. Then I reckon the US 10s is going to come much closer, or even go above 4%, and then it's going to be more of a mess than than what it is now. Yeah. So
Yeah.
and on the data, on the news front, no, I don't really see much more than what you have been saying already. There's going to be a lot happening in the coming week as well. We can talk about that towards the end of the week or on Monday or so, because we've got the Chinese 2 sessions also starting, where it's rumored that Xi is going to take more control of the Chinese finances as well, getting more involved in whatever happens to even monetary policy, if we understand what the specialists are saying. So there's still a lot to happen.
Yeah, definitely.
Sorry, just to finish and just to confirm what you said before regarding my own view on Bailey. We're running pretty close to 100% of hit rate when Bailey talks that Sterling's getting out. I maintain my view. On the day Bailey speaks, don't be long Sterling.
we should probably patent a trading indicator, the Bailey, the Bailey trade.
Yeah, the Bailey bullshit indicator, BBI.
Yeah. As soon as he speaks, don't be long. Yeah. But it's right what you say about ISM, and I'm going to be looking on the other side. If it is a good number, I want to see how much more yields and the dollar can do, because I think, it's looking potentially like we might have priced this phase of Fed expectations. If we look at 10-year yield, getting just up to that 9.98, not quite 4% mark. I'm beginning to wonder maybe that's the area we've priced for now, unless the data really starts kicking on further. That means much higher CPI, not just 1 month of PCE when all the CPIs have been still coming down, but all moving in the same direction. Because remember, we are really only trading the potential for, maybe the rate ceiling to go up another 50 basis points. That's not 700-800 pips more in dollar pairs. And even the higher for longer stance doesn't mean we're going to be shooting rates to much higher than that potentially. So we've had a decent bit of repricing already. We've got some levels to look at. Dollar yen got up to right into that 137 zone, right into those moving averages, and I managed to make a mess of that trade as well. We got right up there into the DMAs. Didn't quite touch 137, but close enough. I jumped in a short and then got cocky and tried to reverse it over the fix at 136.50, and got taken out of that, and it's come all the way down since. So made a bit of a pig's ear of that one. I know some of the guys in our room rode that nicely from the top there, but technically, it's worked. The levels worked. So that's set a marker now, this area into 137, has set a marker. If we get strong data from the ISM, I'm going to be watching closely to see if we get a move up there and how the price reacts. I was waiting to get over the month end for my core shorts, which aren't in the best place at the moment. So if we do get another test and hold of this 137, I'm going to potentially look to add to that position, give myself a bit more leeway, see what happens. It may be a case that if we do get a decent pullback, I might try and get out on the average or lower my risk on an average basis, rather than thinking this is going all the way down to 127 again. So for the moment, I'll be looking for the data to see if it's good. Are we going to see yields going higher, or have we found a bit of a ceiling? If we found a bit of a ceiling, then perhaps the only other way is to move off that ceiling and maybe sit and find a bit of a range. So for something like dollar yen, we may find we're setting up perhaps in a 134, 135 range, between there and 137. We've seen it time and time again where we have repricing and then we find a bit of a range, 200-300 pips, before we get a bit of a move outside of that. So I think we may be seeing some ranging coming ahead, but the price action will be my guide. Kiwi, that break that I had of 0.62 has gone on the stop. We got back above. I did add into this area here, got taken out this morning in the break back above. So this for now is looking like a bit of a short-term fake out. Similarly for the Aussie dollar, had another look at that 67 handle and couldn't break it significantly anyway, or get underneath it, and a decent bounce up, but we're back up to a former break point as well and not getting through that at the moment. That old fib 38.2 that we were all watching on the way down here is now coming in as resistance. So this one is definitely not out of the woods from the bearish pressure. Until we get above 68, it stays bearish for me, at least in the short term. As mentioned, that Chinese data has seen a big pullback in dollar yuan. That is now going to likely become a significant top, as we knew it was potentially going to be anyway, into the 7 area. Again, my longs that I took on the breakdown here at 680, I've been hit on my trailing stop 689.50. I'm not going to complain about that, of course, because I was taking it out way up here. But for now, I'm neutral on trading this one. If we get a move back to 7, I'll judge the price action. That's potentially a place to go short. I'm not inclined to really mess around in here until perhaps we get back down towards this 679.80 area. See what happens down there. If the data is turning positive, this could be just as much a one-way train down as it was a one-way train going up. So I'm neutral on this one. Wait to see if we get a move to any of the edges. Stel, you wanted to show us your magic this morning? I believe.
Yes, sir. By the way, you said a price action is your guide, right? Mine is the force. By the way, very, very quick joke. You heard the one where there's Luke Skywalker and Obi-Wan Kenobi eating in a sushi place, and they're trying with the chopsticks. Obi-Wan is really, really good. Luke is like all over the place, can't use them. So Obi-Wan turns to him and goes, "Luke, use the forks." Oh, bad joke. Sorry.
Okay.
Come
I
on.
apologise, folks.
No?
I should stop the show now on that.
Shoot me now. Okay, right. Let me take over the screen.
Ryan,
Yes, mate.
have a word with the editor, please. Once we are done, to cut out 30 minutes to 31st minute.
Yes.
Yeah, we'll edit that out, definitely.
All right. So, quick view at markets from my point of view. I obviously don't look at intraday charts. I look at dailies and weeklies. But as I said before, I think yesterday's numbers will give the Fed something to think about. But for me, the big picture still remains the same for the moment. That is that we are probably going to be going higher in yields for a little bit longer. The market's already pricing higher rates for both ECB and the Fed, and for longer, and I think they're going to continue to do so. So what I think is going to happen, I think 10-year US is going to break above. And look at this, if we go to something like the 4-hour, it's a very, very nice kind of consolidation. It's a, I'm not going to draw it perfectly, but come on. Sorry, let me take out the magnet because it really annoys me. So something like that. And I think we're going to break higher. And once we do, I think we're going to be retesting that 433 high. I've been talking about that for a while. Now, from that point onwards, it's anyone's guess. I think if we do break out higher, I said this yesterday, we are going to, obviously, for technical reasons, I think new longs, stops, etc. We're going to push towards, 450, 460, but I think that's going to be the last terminal move because these high rates and the tightening are slowly taking effect in the economy, and things are going to turn, and they're going to turn in a bad way, and they always do. When there's a hiking cycle, especially if there's a fast one like this one, it always catches up with the economy. And if you look at the average consumer, well, disposable income is being drained. All the gains in excess. I don't want to say, I was going to say excess reserves, but, cash flow that people got in from COVID and handouts, that's all gone now. And credit card debt is at, if I'm not mistaken, all-time highs in the US. This is not healthy. Remember, credit card debt is, it's 15, 20%. It's costly. So my view is that the average consumer is feeling the pinch. Everything's getting more expensive. Wages are also going up, but they're definitely not keeping up with inflation. And that's a fact. So it's tough. Plus, if you add the fact that housing has already turned, mortgages are higher, so there's more supply, less demand, etc., etc. House prices are going down. The wealth effect is being felt in the wrong way. So the average consumer is having issues, and I really can't see how the economy is going to keep going from strength to strength on fundamentals like that. So my view is we go higher in yields for the short term. This coincides with a logic says it coincides with a risk-off move. We have already seen a move from the highs in the S&P. Oops, actually here are the highs. 4,800. We're back down to 4,000. Yeah, up from the highs. If we do get up to 430 odd in a 10-year, I think we can pretty much assume that we're back to 3,600 in the S&P. I'll be really surprised if we're not there. The first target is 3,800 for sure. We're, as I said before, I know I keep repeating myself, so please, bear with me, but my charts don't change from one day to the next. So we have some DMAs here, which are pretty important. We're fighting with these. If you can see, we're trading between these two. There's a trend line as well. Once we break that, it's 3,800 and then, back to 36. And that will be a pretty reasonable pullback for the S&P if you look at what we've done since COVID. And even pre-COVID, I've been talking about pre-COVID highs for months and months and months. I think that's a place where the Fed just says, right, that's it. Back to QE, back to cutting rates, back to whatever they can do. And I know it sounds a bit crazy, and people say, no, they're not going to do the same. I think they will. So that's ultimately, yep.
On this S&P.
Yes.
And you just spoke about this 2019 high on the S&P. Okay, there's a perfectly good explanation why it's holding up, because there's a lot more liquidity in the system, etc. Yada yada yada. But in psychologically, don't you think it would be taken as I'm not going to say a victory for the Fed, but a kind of okay management of the asset value situation, if despite assume that you're right and we're going back to 430 on the 10s, for instance, that's going to weigh on the equity markets. So assume that we stop in this 35-36 zone, 3500-3600 zone. Don't you think it's going to be taken as a small piece of victory for the Fed or the market to be able not to go below those 2019 highs?
Absolutely. And also not just the level, it's the way it's getting there. It's very orderly. I think if I was Jay Powell, I would be very happy with markets. Even if we get to 38 or 3600, I'll be very happy. It's a very nice retracement. But having said all that, think about how much money was poured into the system since 2020. So, with money supply being unchanged, it would have been a very nice retracement. Of course, it's a victory. But if you think about what a dollar buys you today versus even 2 years ago, 3 years ago, it's if you adjust it for that, then it's obviously a bigger drop. But in nominal terms, yeah, of course. And the way it's getting there, I think Jay Powell would be very, very happy, and I'm sure he is. Yeah.
Yeah.
And if you scroll even further back, I mean,
don't forget we have QT running in the background.
Of course, and they're doing all that. They're doing QT. They're unwinding balance sheet and everything, and the market's not crapping the bed, which is a victory. Yeah, definitely.
Yeah.
Now, if we do get, if you do get a sharp move, especially if you get down towards those pre-COVID highs, I think that the Fed is probably going to panic a little bit. But it has to be a kind of capitulation move. If we keep going slowly like that, it's like the boiling frog, right? It happens slowly, and you don't realize it. But So what I worry about in terms of market valuations is all these people who got into what's the name, Robinhood and all that, and we're buying stocks with the COVID money, and we're getting long up here, and cryptos and all that. So that I worry about those, but you gamble, you gamble. Currency wise, I still think the euro dollar is trading sideways. Let me go back to a 1 day. Both central banks still in tightening mode, still, kind of surprising to the hawkish side. The Fed is telling us they're going to be doing more for longer. The ECB telling us they're going to be do 50s, couple maybe, I don't know how many. So this pair is being pulled from both sides. So I don't see any major direction on this. If you put a gun to my head, I'll probably buy it, but I don't see any major direction. Obviously, if yields go higher in the US, they're probably going to follow in bonds as well. But generally speaking, 10-year US goes higher in yield, the dollar kind of rallies a little bit. But for the moment, I see the euro dollar going flat. I mean, obviously there's daily moves, but DXY is kind of ranging. We really have to go above probably 106-ish. There's these highs here, 105.60 something. So probably get to 106 and above for me to think that we're really getting to move higher, or drop below these lows, 103.40, which is probably going to be coinciding with the 50 DMA for me to get bearish. So at the moment, I think we're ranging, and looking at things like metals, also, I think we're ranging. I'm going to ignore the last couple of days, which are pulling back higher. I think if yields go higher, they are bound to go lower. So yes, we are seeing a nice little recovery, but it's still a downward trend, and I still think the most likely scenario is we see one more low in both gold and silver, and hence my hesitation in getting very long these. I'm very bullish, but I'm gonna take my time. I am already long a little bit of silver. You know me, I tend to be a little bit early with my entries, so I'm long smallish position at about 50 cents from here, above here. So I'm negative on this, but as I said before, I'm going to be loading up more somewhere between 18.30 and 19.10, depending on how we go, if we go there. So yes, we are going higher in metals, but I think it's just a short-term blip. I think we're going to be going a little bit lower, but I always want to have some position in just in case something starts flying higher. So that's my strategy on that. I will keep trading it as I have always traded it. Cryptos are doing well. They usually do on when equities rally. And here we really need to see 25.3 and above for Bitcoin to call it a breakout. We are now kind of consolidating, although it looks like some kind of bullish consolidation, I have to admit. The overall structure here was looking bearish, but this is kind of negating that. So I think this is no longer looking bearish, and every opportunity cryptos get, they outperform on the upside. They outperform by quite a margin. So they are looking strong at the moment. But having said that, if yields go higher, I think we have to see a move lower in cryptos. A very, very similar story in Ethereum, actually a lot tighter. And have to see something above 1740 to call it a breakout, or maybe this trend line here, which 1715 or whatever that is. Pound's getting a beating, but I still think that the bad days, the dark days in the pound are probably over for now. I think you guys will remember I changed for those who are ForexAnalytix members, I changed my macro bias after a long time from being bullish. I changed it to neutral back just above 89 a couple of weeks back. And I think that especially given this Brexit development, I know I've been talking about it for 5 years, but I think a lot of bad news have already been priced in, and the pound has underperformed over the past months. And I think the most likely scenario is now we kind of range trade with a slight bias to go higher in the pound, so lower in euro pound. The cable is a little bit different because I think that the dollar is probably going to strengthen in the short term due to yields going higher. But also, these 124 or something, I know we're not that close, but I think these levels are going to hold. And these levels, this is the resistance that the pound really has to take out for us to get bullish. I think this kind of consolidation here is probably going to resolve itself to the downside as the dollar strengthens. If what I think happens is going to happen with yields. But as I said before, I don't have a bias, a bullish or bearish bias on this, because I do think that the pound is probably going to find some support, having really traded badly over the past few years. I mean, if you look at the way it's traded after the Brexit vote, it's been disastrous. What else can I look at? The yen. We talked about the yen. It was consolidating up here. It broke above the previous highs and then just came back, just in case anybody wanted to get long that. So it's still sideways. I have to admit I was disappointed by what's the name of the guy? Ueda. You guys know the names. I keep forgetting all those. The Bank of Japan at some point will have to change policy, and they just seem so unwilling to do so. So it is.
You know what?
Yeah.
It gives me the feeling of people looking for the pivot in the Fed. They are now desperately wanting to see the BOJ give up YCC. And somewhere there's a risk that they will have to reprice at some stage as well. Yeah, I think, as we were showing so many times, if you look at the daily, there's a big confluence there on the moving averages. The 100 and the 200 are really walking together there.
On the daily?
Yeah, on the daily, in the daily.
Oh, 100 and 200. Okay, I have the 50 and the...
Yeah. And they seem now to that people are watching those, right? We had the top of the cloud up there as well for a while, but that's now coming in a lot lower, just below 135, I think, 135.80 or so, 134.80 also. So that's going to be an important level. But yeah, it was important up there, right? And we've been signaling that. A few of us have been trading that in the room as well. So that's been a decent trade up there.
Yep. The other one I always look at is dollar mex, and that seems to, well, it seems to be breaking again. I don't know what to do that. It has such great carry to be short this, but I'm scared of shorting the dollar at the moment. So I've may have missed this. I don't know. You know, I hesitated, so I don't have a position, but this is definitely a good short. If you're short already this, it's a really good trade. You get paid for this, and you kind of know where you're wrong. You know, I would probably say not these levels. I think anything above 1850, 1853, 52, yeah, 1852, and you're wrong. It's a nice short if you have it. I've been talking about it, and stupidly I haven't done it. So
there's a trend line coming in there as well around, like a wedge trend line coming in there as well around it, and that's around 1852 right now as well. So
okay,
it's a decent level to, and that replies actually to the question that somebody Abir had on. Is it ripe for a long, the dollar mix? Well, if you look at the global picture, Abir, I hope you have a really good butcher's glove, because it's any other glove could be pierced quite easily by this knife. So
yeah,
I don't think it looks ripe for a reversal. It doesn't look like it, right?
And you got to watch the carry as well.
And the carry, but it depends what you want to do. If you want to buy it for a couple of hours and not having to worry about the carry, it's okay. But also don't forget we are Wednesday, and if you're long for more than just intraday, you're going to pay 3 days of carry.
It's T+2, right? Yeah, so it's 3 days carry. Yeah, you're right. Yeah. Okay. All right, that's more or less what I had. I know I repeat myself sometimes, but hey, that's the way I look at markets. So I apologize for that. So I'll pass it back to you guys.
Yeah, no worries, mate. And probably worse than your joke, Alan called you Steve earlier.
Oh, that's I take that as a big insult. No, I'm kidding. I love the guy. He's actually not feeling very well these past few days. So
yeah, a bit under the weather.
I might go over and see how he's doing. Anyway.
Yeah. But he was talking about the S&P, because obviously he sees 10 years up here. He sees the S&P's down at around 3,000-ish. I think my only response to that is yields are here and we're not down at 3,000. I think the price action says it all on that one.
I think he meant if yields go to 430.
Oh, if yields go to 430.
Yeah.
Okay.
Yeah.
Right. Well, I'm sure we'll hear from Alan anyway. He's in our chat room. He'll put us right one way or another, I'm sure. Right, Kay. Well, we'll still cover most of the majors, so you know.
Yeah,
you've got to look
perhaps
at.
we can. If you want, I can show just a quick few crosses or so today.
Yeah.
I'm just going to quickly show the intraday dollar yen, because there's a little bit of a support right around here, right around this 50-60 on the dollar yen, and we are trading bang on it right now. And I'm also seeing that the US 10s are shying away a little bit. And I was saying this morning, this this ISM is the markets are nervous one way or the other, because we see it from the amplitude of the moves that we can see. There's absolutely very little reason for the dollar yen to come off 100 points or to go up 100 points at the start of our day, but yet we are doing it. So keep a close eye on this one, and just for the intraday. And then the one that I was showing, the cloud here is around it's a 134.75 today. So if ever we get down there, this is something that's going to be watched by the Japanese. Yeah, just wanted to go over a couple of those crosses. Euro sterling basically undone in a few hours what it did over the course of the past week. So that should tell us that whatever we saw from the start of this week at least is likely to have been just one big end of month trade. I still think there was a bit of positivity over a EU UK deal, which may have helped it lower a little bit. But interesting to see is that we held the low of January as well. So well, this low at least. And now we're already spiked higher. We've broken back through all the short-term resistances already, and we are close to the 50% of the move from those latest highs back down. Simon in the room also showed 61.8 of this move, so it's all happening around this 88, 60, 67 in euro sterling. If that goes, we're probably looking at a move back into this 89 area. Another one that I would look at this morning is EuroCAD, and yesterday I bought this one. At the end of the day, we had the spike, then it came back down on the fixing, and as we've been highlighting already, this 144.5 is 44.40, 40.45, and then we have a bit of a trend line here. But over the course of the past few days already, it's showing a bit more elasticity, or is a wrong word, but a bit more positiveness here, and we've been saying that this level, the more you retest it on the top side, the more there's a risk that it gives way, and this is what it's apparently doing right now. As usual, I've already managed a bit of the position because I usually do it, and so I make the trade as free as possible, as soon as possible. There may be a little bit of resistance coming up here around 145, 10.15, but I'm expecting now this 144, call it quarter or half zone to come in a bit bid. And I would say, and people, regulars of the show know my my style of or way of sometimes using correlations between the American bloc and the rest of the world, especially Europe. And I think if the after the Canadian data yesterday, even if they are backwards looking, right, for December and last year. But the Bank of Canada being already a little bit more mellow. Lately, I've not been that bullish on the Canadian dollar either. And if we get a bad ISM later today, this could actually move a little bit higher, not only on risk off, but also on this consideration of the Americas bloc versus the rest of the world. And oh, the last one here.
Just on that EuroCAD.
Sorry?
Just on that EuroCAD, obviously
Yeah,
keeping an eye on that big topside area. Would you flip it around up there?
This one?
Yeah.
Yeah, we have to. You have to try it, right? At least short term. You have to try it. I think it's strong enough. It's been showing up so many times. There is definitely interest up there. So well, I don't know if that interest is now gone, but I mean, technically somewhere, unless we are seeing the Canadian, as I've been saying as well, we're data dependent. I am data dependent, really, and I've been saying that for a couple of days or a week now. I'm going into data dependent as well mode. If Canadian data start to weaken materially, and European data are holding up, then this thing is probably going to be toast sooner or later. But in the meantime, technically, it's such a big area that perhaps you go like just a small short and then double up if it on the other side if it breaks. That is how technically one would trade it, right?
Yeah.
Last one I perhaps on the day that I want to show is this this Aussie Kiwi. This is the divergence trade we've been talking about, and I really missed it, and I didn't have the I don't know actually why I haven't been trading it. Perhaps because I was also looking at that break in the Kiwi dollar sub 62. I think so. First of all, the wedges ranges have broken, and then we had this acceleration. This is really the RBA, RBNZ divergence trade. Australian numbers are not great, and it's actually a bit surprising that we are trading at the lows, because good Chinese data have traditionally been good for the Aussie dollar. Now we have it on you can see it on the Aussie versus the US dollar, but the Aussie on the cross side is not strengthening at all, not on this cross nor on other crosses. So we have a little bit of a zone here at 108, but then I'd advise people to be very careful if ever this comes into play. 107, call it 0545. That to me is going to be a big zone. Lots of high lows here in the past. Keep a very close eye on what's happening here. It could be enough, because if you have like 1.5% differentials in interest rates, it's valid for a move, but at some stage the move will have played out, and I would really be careful, and I reckon it's probably the width of the channel as well. If you think about it, no, it's probably no, that's already done. But this is a big zone that I'm going to pay very close attention to, especially also listening to what's happening between China and Australia on the coal situation and everything. Really, I'm going to. It's enough for today, no? I'd say watch out though for what's going to happen on the euro dollar. No, and the European yields are pushing higher, and we are pushing again in the short differentials, and that's one of the main reasons why euro dollar is where we are. We're starting to push up against the traffic zone box. We have been. This is inverted, okay? So the higher it goes, the better it is in theory for the euro, because the less interest rate differential there is between the short-term euro and the short-term dollar. So we are nowhere near where we were when the euro was trading up at 110. But keep an eye on if those differentials continue to narrow, and that's also why I think the ISM and the PMIs this afternoon could have an impact on this one. And this is the Bund, not the Bund. These are the German 10-year yields. If you look at that, we're pushing up against highs here, pushing up against extension, pushing up against the latest highs of the channel. So if this holds up together with the short term, and you can overlay different currency yields, right? Like Canada, for instance, the Canadian yields have had the tendency of getting a little bit heavy, and the European yields are pushing up. So that is also pushing the Euro Canada up. And I tend to look at yields a lot. So keep an eye on this one. If that pushes through, that should really put a bit under the Euro as well. And you know, we were talking, that's really the last one I'm going to show. We were talking about this euro dollar in the 104 zone. I've got the impression that unless something really comes out very positive for US and drives it down lower, it starts to feel to me that 105 low prints in the euro dollar could be enough for this round. So that is just a general feeling that I wanted to share right now. And with that, I give it back to you, Ryan.
Thank you very much. Well, just before we go, Ali's asked why is gold surging higher? In this instance, grab your gold chart, overlay dollar yen. You'll see exactly why gold's going higher. Purely a dollar move for me. One thing that is surprising, given those Chinese PMIs and the better data, the oil is down today. That's not something that computes in my mind. If China's picking up and it's a global boom for the global economy, you'd expect oil to be jumping, and it's not. So in that sense, no idea what's going on there. But for gold, Ali, just have a look at the dollar, overlay dollar yen, and you'll see exactly why gold's moving back higher. Anyway, that's it for today. Thank you very much, as always, for coming to the Flow Show. Watch that data later on. It could be a decider for what's going on with the dollar. The mood today is we're dollar bearish. So if that data sends a dollar higher, that may be something to look at for a fade. I'm certainly going to be looking at it from that aspect myself. Until tomorrow, boys and girls, have fun. Thanks to Kay and Stel. We shall see you tomorrow.
Thank you, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.